So we can start. So you're muted, sorry.
Respected Chairman, of SIRC of ICAI in absentia, and the Secretary inaugurate and take care of this. Is that okay? Ignore it.
Yes, yes.
Okay.
Yes.
Yeah. Sorry. I welcome the speaker of the day, Ramesh, Kumar sir, and the participants of the day. Yeah, welcome. This is a different type of program. This is accounting standards relating to financials closure, AS 11 and AS 18. Much useful for us, the errands, and definitely our people can be benefited because of this program. Yeah, because most of us have to be familiarized in our accounting standards. As the days goes, maybe everything will become mandatory, and we'll have to be very careful in signing the accounts. So it will be much useful all of us, and this is especially accounting standard 11 and 18. Now I introduce our speaker. Sri Ramesh Kumar Malayala sir. He's got many registered valuer and a forensic auditor with over 9 years of experience in handling large and mid-sized entities operating in technology, manufacture, equipment renting, health and fitness, real estate, infrastructure and logistics. Great, sir. All the best. So you have done wonderful. You have got the good experience in various types of fields, and his functional expertise is in IFRS and Ind AS, valuation and business modeling, virtual CFO, internal audit, VAT in GCC countries, and he has got varieties of work experiences. And at the small years of your service, I think you have got a big experience in work, and it runs to pages. I think I'll not be able to complete this. Otherwise, you'll be hearing only me and not the speaker. So I'll just highlight one or two. He has implemented Ind AS for list of companies, and he has handled project costs and finance. He has handled corporate valuations. He has been independent, handled business and financial modeling for Indian-made foreign takeover companies. Actively involved in SOCPA adopted in IFRS in the Kingdom of Saudi Arabia, implementation of IFRS and IFRS 9 and IFRS 15, 16 in United Arab Emirates. Independently handled business and financial modeling. Independently handled business and financial modeling for valuation for international logistics companies, and he had handled VAT implementation for a group of companies in UAE and KSA. Handled VAT implementation. Yeah. He had also handled end-to-end internal audits for construction companies, and he had did process study and GST for multinational logistics companies, and he has independently handled investigation audit. That's fine, sir. I appreciate this. Investigation audit on super stockists. Led the team on system review, and he is also working as a CFO for certain companies, and he is monitoring and training, handling corporate training in IFRS, Ind AS, accounting and valuation, coaching and mentoring young talent in the fields of IFRS, Ind AS, accounting and various laws in Chennai since 2013. Great. Good support to the people who are coming young, sir. Resource persons for IFRS and Ind AS and accounting in various branches of ICAI, Chennai, Hyderabad and Visakhapatnam, and is a visiting faculty in various branches of SICASA and official study wing of ICAI. And he has got IT skills in accounting, environmental, dealt with SAP, Oracle, Tally, Sage, MS Office, and Microdynamics AX. And he has got a good vision to serve a wide spectrum of industry and become highly professional, reliable, immensely respected in the field of IFRS, Ind AS, valuation, and business modeling. All the best, sir. You've got a good ambition, and I hope the members would be enjoying his presentation and will be enriched by knowledge in this presentation.
Sure.
I leave the forum to you, sir. Thank you, sir. All the best. Thank you. Thank you.
So very good evening, all. First of all, thank you, Sundarajan, sir. Yeah, I don't think no one has till now read out the entire profile like how you have done, and I don't really expect that also. I've just shared it across, otherwise that's not really required. So kind of you. So happy to be part of ICAI again during this pandemic and post-pandemic also. We are still continuing with live sessions. One happy occasion is I'm still sitting in the client location, so finish off this meeting and continue with my work. So that is the comfort what online sessions have really given us. Otherwise, travel all the way from Sriperumbudur to ICAI Nongambakam, get it done and then go back is quite impossible. So happy to share whatever I know with respect to the accounting standards part. So today the session we would be dealing with two very simple standards, in fact, but the problem is they are standards which many times the accountants might ignore considering in their books of accounts while preparing their financial statements. So that's the reason why we have picked up these two standards, so that we will have a proper presentation in the financial statements with respect to Schedule 3. So whatever changes we have recently seen in Schedule 3 also we're going to cover, and how it is supposed to be brought into the books of accounts. Second, how presentation is supposed to be done is something we're going to see completely. Okay, so with this short intro, let me begin with the presentation.
It was visible, sir. Now it's turned off. Can you share it again? Yeah, now we can see the other page. Can you navigate to PPT? Yeah.
Okay.
Now it's visible. Continue.
Cool. Thank you. So the two standards what we are going to see today is AS 11, which deals with Forex, AS 18, which deals with related party disclosures. I'll first take you through the standards, because without having the basic understanding, ground set, it would not be appropriate to directly jump into the practical issues. So for that reason, I would first take you through slightly about the basics of what the standard is, basically what the scope is, and how the accounting is required to be done. Post that, we will also look into the practical scenarios, what generally we see to be difficult. Okay. So every standard, what we are going to look through is going to be backdrop and overview as to why a particular standard has come, and then what's the objective and scopes. When I say scope, it's not just the scope, even the scope exclusions are going to be seen. And then we'll see few practical use cases which are given there as case studies, and then we'll go with presentation and disclosure requirements for each of these standards, so that we'll cover these two standards holistically. That's the objective here. And reason why two standards are picked up is, as I told you, these are small standards, and within 2 hours of time, yes, we can definitely quickly wrap up these two standards, and we can have discussion amongst ourselves. With any practical issues if you are facing, we can have the discussion as well. So to start with, first we'll finish off AS 11. overview is fairly simple. Yeah. Overview is fairly simple to give a very clear structured accounting with respect to any foreign currency transactions. Broadly speaking, AS11 does not just deal with foreign currency transactions alone. Even foreign currency operations are also going to be dealt by AS11. Apart from that, for a particular area where we do not have a standard separately, AS11 has facilitated that particular part also, that is with respect to forward transactions in international markets. So broadly, there are three things which are being covered under AS11. One being transactions, that is foreign currency transactions. Second is with respect to forex operations, and third is with respect to forward transactions in international markets. So these are the only three aspects which are being covered inside the standard. So as I stated, the three parts which are going to be covered are here. And exclusions wise, it's very important to identify these parts. The first thing is specify the currency in which an enterprise presents its financial statements. See, when we prepare financial statements, there could be entities sitting in India preparing financial statements in US currency, USDs. Reason being, they have their parent company sitting abroad and they want the financials to be prepared in USD but not in Indian rupees. In such case, this is not something covered under AS11. We are not talking about the presentation currency discussions in AS11. We are only talking about foreign currency transactions. If I sitting in India transact with a country abroad and there is a foreign currency involved in it, in such case this standard is applicable. But it's not a case where I'm sitting in India but I prepare my financials for the sake of my holding company abroad in USD. In such case, this standard is not applicable. That's the first exclusion. Second most important thing is with respect to presentation in cash flow statements, how where the forex changes are supposed to be considered and all. This standard has not been concentrating upon its disclosure requirements because AS3 has specifically given its own guidelines in it. Hence, that's not considered here. It's completely addressed only in AS3. The third important aspect where this is not applicable is exchange differences arising from foreign currency borrowings to the extent that are regarded as an adjustment to interest costs. Now, what's this basically? At times, what happens is forex loans would be taken by entities, and the interest is supposed to be paid in foreign currency for the loans which are taken abroad. And this standard would not be applicable for changes in interest being paid out, which means, say for example, I have a payable of 1000 USD for a loan which is taken every month. Today the USD rate could be 70 rupees. Next month it could be 75 rupees. The next month it could be 60 rupees. The differences in value which I am paying out will fluctuate. These are not areas where this standard is focusing upon. We are more concentrating upon the transactions rather than the interest differences which come because of this foreign currency fluctuations. And then lastly, deals with restatement of an enterprise financial statements from its reporting currency into another currency for convenience of users. This is basically, in fact, this is a point where our IGAP, that is AS11 and Ind AS differ. In fact, Ind AS and IFRS also differ because AS does not specifically mention how the financial statements can be prepared and presented in different currencies. Such information clearly is provided by Ind AS and also IFRS, but AS does not do that. That is the reason why in AS we only have two currencies. One is called as the domestic currency, second is foreign currency. That's all, only two currencies. But in Ind AS and IFRS you have three different currencies. One is presentation currency, second is functional currency, third is foreign currency. So such identification of different currencies does not exist in AS11. Hence, we are keeping it out of the scope for AS11. Then definitions, I'll keep it aside. If time permits, we will see it little later, because these are something which most of you would definitely know is what I believe. So I'm going to keep definitions apart, because I would like to concentrate on the context rather than the definitions part. I hope you all would agree with that. Yeah. So coming to foreign currency transactions, that means I've told you there are three things in which the standard generally operates. First is transactions, second is operations, third is forward transactions. So today we are going to broadly see only transactions and operations, because forward transactions is not a serious issue right now for AS companies. That's the reason why I am going to touch it slightly, but will not go deep in it. So foreign currency transactions are dealt in three parts. First is initial recognition. Second, on the balance sheet date, if it happens to have a balance sheet date in between initial recognition and final settlement date. And third is recognition of exchange rate differences. So these three are important aspects which we are supposed to look in foreign currency transactions. So coming to initial recognition, always initial recognition of any forex transaction would be at that rate at which we have purchased or sold a particular or entered into a transaction. And at times there are a few practical issues here which generally come in. That is also something which I have put on as a paragraph for you. If it is a case where I am someone who trades in forex very rarely, that's absolutely fine. Maybe one transaction a month or so is what I do. So I can identify that particular transaction on that particular date and close it off. But what if my day in and day out completely goes only in forex? Should I keep tracking every invoice in which I transact for the rate at which I have entered into the transaction? Is the question what most of these export companies or import companies generally face. So at this juncture, what I would like to convey is, if it is a case where your daily operations itself is in forex, there is no requirement that you should definitely pick up the same rate at the same point of time. What generally entities do is they would pile up a few transactions and put them together in a weekly basis or so, and for all of them put together a specific rate can be applied. Average rate for that particular period can be applied. Or if they feel the rates are so fluctuating within a week, yes, then there is a requirement to identify specific rate for every specific transaction. If it is going to be a very minimal variance, say 1% or 2% of variance in the entire bunch of transactions in a week, so those do not really require to identify different rate for each and every transaction. You can go with a single rate and get the booking of invoices done. So this is what's presented here. So for your convenience, you can look through the second paragraph. A rate that approximates the actual rate at the date of transaction is often used. For example, an average rate for a week or a month might be used for all transactions in each foreign currency occurring during that period. However, if exchange rate fluctuates significantly, the use of average rate for a particular period is unreliable. Okay. Next. Reporting at each balance sheet date. First of all, there are two kinds of items which we need to look at. One is called as a monetary item. Second is a non-monetary item. What does monetary item mean? Something which gets converted into cash immediately, which will have that facility to get converted into cash immediately. In such case, we call them as monetary items. Non-monetary are those which might not immediately get converted into cash. Then you call them as non-monetary items. So examples wise, if you ask me, bank balances or else if you have a foreign debtor receivable, then that's a monetary item, or a foreign payable, that is a creditor, then that's also a monetary item. Non-monetary items is basically something I have purchased, non-current asset or an investment I have made, which I might not be in a position to exit out of the investment immediately. Such cases we call them as non-monetary items. Now, generally, all non-monetary items we would consider them either at historical cost or at fair values, but when it comes to monetary items, all monetary items are generally going to be taken only at closing rates. So what does closing rate mean? The rate at which the financial year ending is happening. On that date, whatever rate exists, that's going to be considered as closing rate, and that would be considered for your accounting purpose. Now the next note what comes is how would I recognize the differences between the existing book value and the closing rate? Any differences between these closing rate value and book value, you can charge it off to P&L, or it can be considered as a profit and taken it off to P&L also. Now, when it comes to non-monetary items, as I told you, they are generally carried at historical cost. However, if you have, there are few non-monetary items which are considered at fair values also. Okay, such items you would go by fair values only, and then show it at the fair values. Whatever difference exists, that would again will hit only the P&L, be it profit or loss. And as I told you, whatever exchange differences arise, be it monetary or non-monetary items, so all of them put together, we would only recognize them as either an interest or expense in the financial year in which it arises. Okay. Now, if the exchange differences result when there is a change in exchange rate between transaction date and settlement date, in such case what we do is we are supposed to split the financial year. That is, there would be situations where there could be 2 financial years into which a single transaction might spread over. Say I have entered into a transaction in the month of beginning of March, and the credit period is for 60 days, and I would close it only in the month of April end, in which case there is a financial year ending in between. So on that particular date, I'll have to go for testing for this, what is the closing rate value, and accordingly recognize profit or loss in the books of accounts. So this is basically what we generally do in every foreign currency transaction. Okay, so now let's quickly look through a few case studies. X Limited bought fixes its worth 3,000 lakhs on 1/1/20 and was financed by a foreign currency loan which is payable in 3 equal installments. The exchange rates were $1 is 75 and 80 as on 1/1/20 and 31st December 20. The initial installment was rendered on 31st December 2020. The total difference in foreign exchange is capitalized. Okay, so here these transactions would be accounted as follows. So what he is talking about here is he has bought a fixed asset, and it is bought by taking a loan, forex loan, which is going to be paid in 3 equal annual installments. Now, how do I deal with the situation? At what rate should I initially recognize, and then what rate should I subsequently defer it for? So if you look at that, according to para 13, any exchange differences which arise on reporting the enterprise's monetary items or settlement of monetary items at the rates different from the ones at which they recorded or reported in previous financial statements must be recognized as income or an expense in the period in which it arises. So basically, I have a payable for 3,000 lakhs, and first installment I might pay then. but on December I would be paying only on I think by 31st of December 2020. So on that date, when I have recognized initially, it is 75, and then it has become 80. So there is a increase in the value of loan for me. So I'll have to consider it as an expense and increase the value by 5 rupees per dollar. Okay. So the same calculation is presented to you here. So most important thing from this particular standards purview, presentation and disclosures, if you see, the amount of exchange differences included in the net profit or loss for the period is to be disclosed. That means when I say profit or loss identified in transactions, these need not be identified line by line separately for each item independently. For all the foreign currency transactions which are entered, say I have got X amount of profit and Y amount of loss. Should I club them off both or net them off both and show as one particular item in the P&L? Or should I disclose profit separately and loss separately? Are different questions what people generally get. Here I would clearly state that you can go by netting off. There is no wrong if you net off profit against loss, because the transactions are your business nature. If it is that a case where your day in and day out operations generally happen in foreign currency transactions, and you have made some profit in few transactions, losses in few currency transactions, you can net them off and tell that net, this is the amount of profit which I've got from forex transactions, or net off, this is the amount of loss which I've got, is what you could disclose. Second question what comes is, in the same case, what if I have non-monetary items which are supposed to be fair valued, or else I have non-monetary items or I have monetary items which are supposed to be considered at closing rate. Can I bring them also as part of the same account, is the second question. Yes, you can. All the impacts put together, be it profit or loss for a with respect to foreign currency transactions, you can bring them all together and show it under only one head and close it off in that particular account only. That is number one. Next, net exchange differences accumulated in foreign currency transaction reserve as a separate component of shareholders funds, and a reconciliation of the amount of such exchange difference at the beginning and end of the year. This is something very, very important. I have another important aspect also. I'll first clear this off, then go back to the presentation and disclosures. So there is something specific with respect to FCMI TDA, which is foreign currency monetary item translation difference account. See, generally foreign currency monetary item translation difference account means this occurs where I have foreign currency items, and because of the translation into Indian rupees, there could be some difference in the trial balance what I translate into Indian rupees. So when I convert them into Indian rupees, trial balance into Indian rupees, there would be some difference. The difference would be parked as part of FCMI TDA. Now, if it happens to be a asset, if it happens to be a positive figure, that indicates that that is an asset. But technically speaking, you will not really get any benefit out of it in future. So it really does not give you any value by showing it as part of your assets. In which case, what standard has very clearly mentioned is, if you have something called as FCMI TDA due to foreign currency operations being converted into Indian rupees, in which case do not show it as part of assets, be it positive or negative, show it as part of your liabilities only. In liabilities side, which part should I show? Show it as part of reserves and surplus. show it as part of reserves and surplus, and that's going to be identified separately as a line item in the financial statements in reserves and surplus. That's very one important aspect which is clarified by this particular standard. Now let's go back to the presentation and disclosure, other aspects. So now we are at the second point, which talks about if there are any translation reserves, those cannot be clubbed with regular reserves. They are supposed to be identified separately only. Why I have linked that, and this here is in general presentation and disclosure standard has clearly told you how it is supposed to be presented. That's all. But what if it has got a negative number? That is, it's supposed to go and sit in asset side. Should I consider it as part of assets? No, it should not be considered as part of assets. It should continue to sit only in reserves as a negative figure. That's what the clarification which is given by this particular standard. That's why I've linked both these together here itself. Now, moving to the next part. When the reporting currency is different from the currency of the country in which the enterprise is domiciled, the reason for using a different currency should be disclosed. The reason for any change in the reporting currency should also be disclosed. Now, this is a case which most of the entities who have got a foreign holding company or another controlling entity sitting abroad would generally face. For Indian requirements, they might prepare accounts in Indian rupees. For their parents' requirement, they would also prepare the financial statements in that particular currency. At times, what they do is, for the sake of convenience, for the ease of operations and all, they would stop presenting it in Indian rupees and present it only in that particular foreign currency. One good example I would like to take here. There's a company in Chennai, which is basically a logistics company. I do not want to take names here. This particular logistics company has been preparing its financial statements in Indian rupees all its years. Almost after 25 years, when it got an opportunity of getting purchased by a large international organization who wanted to have some place of presence in India, has invested in this company, had purchased controlling interest in this entity, and later on clearly stated that, look, I don't want you to prepare accounts in Indian rupees. I want you to prepare it only in Hong Kong. Hong Kong currency is what they've asked for, and they've moved it off. Now, when this came in, the requirement is, being in India, they have a requirement to prepare it in Indian rupees. But that's not mandatory for them. As long as they can disclose why it is not being done in Indian rupees, they are free to go. They are free to provide explanation and give it done. So they started preparing financial statements in Hong Kong currency. That point of time, the financial statements, when they were drafted, in the notes to accounts, we have made a very clear disclosure about all these aspects, stating that the entity has been operating in presenting the financial statements in Indian rupees all these years. From this year onwards, it's going to present it in Hong Kong currency, and due to this difference, XYZ are the factors which are different, and we would disclose all the information in the notes to accounts itself. So this is how we do whenever there are foreign currency. Yeah, there is some, I think someone has.
Just tell me, sir.
Oh, I thought there's someone who has asked a question. I have seen that blinking. Okay, I think it's you. Yeah, fine. I've just seen the chat box question. That's all. Thanks. Yeah.
Is my screen visible? There is one question, so you can take it up, and then I'll give you the present rates back.
So if the exchange difference is capitalized, how the same be accounted in the P&L? When the first installment is paid on 31st December, where 5 is more on repayment and partly wants to capitalize the same asset. So first of all, there's no point of capitalization here, sir, because even if you consider borrowing cost concept, borrowing cost can be capitalized only if the asset happens to be a qualifying asset. So here there is a outright purchase of an asset. So capitalization context does not come here at all. You would only charge it off to P&L. I hope I have answered that.
Okay, so that was one question that came up till now. We'll wait for some more, and if there's any, we'll share the screens at the end of the session. I'll give back you the presenter, right? So you can continue the presentation.
Yeah.
Now you can start sharing your screens. Yeah, visible.
All right. So that's with respect to presentation of para C. So we are more concerned about in which currency it's being presented. That's the very reason why we highlight the currency in which it is being prepared. The financial statements are being prepared. Okay. And apart from this, from disclosures perspective, we are supposed to specifically mention in the notes to accounts how the financial statements are prepared. If at all there are any foreign currency transactions, we are supposed to give a clear note on how it is being accounted for, and if there are any forex assets and liabilities in the financial statements, those are also supposed to be disclosed in the notes to accounts, stating how monetary items have been treated and non-monetary items have been treated, and what is the impact due to these monetary items and non-monetary items, and also exchange gains and losses impact in the P&L. So these presentation and disclosure requirements are required to be done from the standards perspective. Okay. And when there is a change in the classification of a significant foreign operation, an enterprise should disclose the following. Now, first of all, we have not till now discussed about foreign operations. To give a brief about it, foreign operations indicate an entity established in India having a branch abroad or having a subsidiary abroad. Such entities, we call them as foreign operations. And these foreign operations need not always be integrated. They could be non-integrated as well. What does integrated and non-integrated generally mean? If the operation abroad happens to be so aligned with the existing entity such that entity, without that foreign entity, I will not be able to operate my business here. In such case, I call the foreign operation as integrated foreign operation. If that not be the case, in such case, we call it as non-integrated foreign operation. Best example, say TCS has got a independent branch in US, which is operating on its own. Its revenue it's generating, expenses it's incurring on its own. Everything is being taken care by the foreign entity on its own. Only for the initial establishment, there is some money which I've invested initially. That's all. Beyond that, nothing done. In such case, we can call it as non-integrated foreign operation. Other way around, I have a client in US. I want someone to sit and operate there. Hence, I have started a branch and I'm pumping the fund entirely over there. They render services sitting in US and I get money because of that services being rendered. In such case, I cannot survive without that branch sitting abroad. In such case, this is going to be called as integrated foreign operation. So broadly, these are the two ways in which forex operations happen. Now, what we are talking about is, if I start a integrated foreign operation, doesn't mean that forever it would be integrated only. Maybe after a point of time, it might be in a position to create its own, database of resources, or it might be in a position to generate its own revenue. It might be in a position to pay out its own expenses, operate on its own completely. In such case, should I disclose the fact that it is no more integrated foreign operation or not? Yes, you should. Yes, you should. Such disclosures are what we are talking about here. Or it could be vice versa also. Initially, it's something non-integral foreign operation, later on becoming an integral foreign operation. In either of these cases, these disclosures are required to be made. So first one being nature of change in classification, that is from integral to non-integral or non-integral to integral, and then reason for the change, impact of change in classification on shareholders funds. So by making this change, there would be something called as FC, foreign currency translation reserves. So to what extent is it going to impact shareholders funds, or will it not impact shareholders funds, is something we are supposed to give. And then what is the impact on net profit or loss for each prior period presented had the change in classification occurred at the beginning of the earliest period presented. So assuming it's moving from non-operating to non-integral to integral. So if the operation happens to be an integral part of the business, in such case, any forex differences in translating the balance sheet P&L into Indian rupees, we charge the difference into P&L only. So if I do so, how do I impact that in my P&L? What is the volume of impact, is something which is supposed to be specifically mentioned in the notes to accounts. Okay. So with this, broadly we have covered all the aspects with respect to AS11. Any questions till here? If you would like to take up, please let me know. We will see them and then go to next standard.
No, so as of now, no question popped up actually, and we'll go with the next session. If there is any, we'll take it up at the end itself. If there is any. Okay.
All right. So AS18 related party disclosures is another important aspect which is generally not very well concentrated upon. Trust me, if you try to pull out data analytics from whatever financial statements are being filed with MCA, I'm not talking about large entities or listed entities. They have their own set of requirements to be stated. I'm talking about small and medium enterprises, which are corporates. I have already seen for almost like out of every 100, only 10 or 20 financial statements would have details about the related party transactions. Others, I'm not trying to find fault at them. It could be a situation where there are no related party transactions. The second possibility is what really provokes me to tell this. Second part is there are transactions but ignored to be considered in presenting. This is a pure disclosure standard. This is a pure disclosure standard. It has got nothing to do with accounting. This is a pure disclosure standard. It has got nothing to do with accounting. It only talks about what all disclosures are required to be done in case there are any related party transactions involved in the entity. First caution, what's to be understood is there is no wrong in having related party transactions in entities, and that's a very common thing what we see. Say for example, Reliance would like to enter into a fiber optic cable contract, and definitely it would ask someone within their circle or within their group companies only to execute it first. If the group companies, one of the group companies, do not have that ability to perform, only then they would go to some other company outside. Till then they would try to engage someone within their own circle or within their group companies to get the work done. Now what is important for us to understand from the standard is it's very common to have related party transactions. All that is being asked by the standard is to disclose whatever related party transactions are, so that the users of financial statement would be clearly aware about what is the amount of market they are able to approach or market they are able to capture apart from serving their own related parties, or apart from getting orders from their own related parties, whom else are they able to focus and get the business from. That's the very idea as to why this particular standard is being introduced. Now, so scope wise, there are exactly 5 relationships which are identified. These are the only 5 relationships about which we will be talking about. The first one is enterprises that directly or indirectly through one or more intermediaries control or are controlled by or are under common control with the reporting enterprise. Reporting enterprise is basically the enterprise in which we are disclosing about the related parties. Look at the language used. There could be one or more intermediaries and controlled or are controlled by. That means I might control somebody or somebody else might control me, or there is another entity and we both are under common control of somebody else. So either of these cases are being covered here. So in short, to call them as subsidiaries, holdings, and fellow subsidiaries. It's like one main entity, the parent entity, under which there are multiple child entities. In such case, we call them as related parties. Otherwise, associates and joint ventures of reporting enterprise, and the investing party or venturer in respect of which the reporting enterprise is an associate or a joint venture. What is this? Say I have an investment in an associate, and there is another party who is also an also a investor in the same entity. Can the other entity who has invested and myself excuse me, can the other entity and myself be called as related parties? We are talking about the associate and then the investing parties. We are not talking about the co-associates. There could be multiple associates for a single business. Those might not be called as related parties unless until we have some other proof to prove that. Okay, and in the same way, joint venturers, co-venturers. Not all co-venturers can be called as related parties. The entity with which I have entered or invested into, yes, that I can call it as a related party, but not the two co-venturers need not always be called as related parties. And then individuals owning directly or indirectly an interest in the voting power of the reporting enterprise that gives them control or significant influence over the enterprise and relatives of such of any such individual. So here we are talking about someone who has got ability to control the entity, which means, say I hold 70% stake in an entity, more than 50% stake in an entity, I can call myself as ability to control. So I would become a related party there. Okay. Then key managerial personnel and relatives of such personnel. Now, when we call key managerial personnel, the entire C-suite comes here. That is CEO, CFO, CXOs, or COO, CMO, all the chief positions. That is what we call a C-suite. The entire C-suite comes here, along with their relatives, and apart from that, key managerial personnel with respect to AS 18, if you ask me, only whole-time directors are considered. Only whole-time directors and someone who is working directors are only considered. Someone who is just for namesake director is not considered as a key managerial personnel in AS 18. However, the definition is different in Ind AS and IFRS. In Ind AS and IFRS, irrespective of a director happens to be, a whole-time director or not, irrespective of that fact, they are considered to be key managerial personnel, and their relatives are also considered to be, related parties only. And lastly, enterprise over which any person described in CND, that is with respect to KMPs, and also with respect to someone who has got controlling interest, is able to exercise significant influence. So there are two things which we are supposed to look here. Number one is controlling interest. Second is significant influence. When do we call someone to hold controlling interest? When do we call someone to hold significant influence over the entity? Controlling interest, basically, as I earlier mentioned, if I have the ability to control, I have voting power in the company for more than 50%, then I may call myself to be having controlling interest. Or else I have the ability to control the composition of board of directors. In such case also we call that as controlling interest. Otherwise, the other entity happens to be subsidiary of my company. In such case also I call it as controlling ability only. So in all these aspects, which I call them as controlling interest. Otherwise, coming to significant influence, so if you carefully look through, controlling interest comes if you have a stake in the entity above 50% generally. But significant influence comes when you have more than 20% interest in an entity up to 50%. So we can put it this way: if a person or an entity has got 20 to 50% of interest, they have significant influence. Above 50% is controlling interest. Okay, so broadly, these are the 5 parties whom we can call as related parties under AS 18. Now, coming to scope exclusions, this is a very beautiful place where multiple relationships can be created, but due to lack of time, I have identified only a few specific areas, but I have covered most of them, is what I can say. So when do we not call something as related party? Just because they have a director in common, we cannot identify 2 entities to be related unless until you have the ability to prove that that single director is in a position to command both these entities. In such case, yes, you have that right to consider them as related parties. Otherwise, there is no requirement to call them as related parties. Next, having a single customer or single supplier, franchises, distributors, or general agents, these cannot be a basis for us to consider them as related parties for 2 entities. And then the parties listed below, in the course of their normal dealings with an enterprise by virtue of only of these dealings. So if they are part of any providers of finance, say SBI has given me loan and also given my friends a loan, or else another party a loan, just because SBI is a financer for both of us doesn't mean we both are related parties. Or you cannot call SBI to be a related party to me. And then trade unions, so the union within which multiple organizations in the same industry have some association, so those cannot be considered as related parties. Or public utilities, public places or public utilities which are used by multiple entities, those also might not be considered as related parties. Or else government departments, government agencies and all, there could be some sponsored bodies, government sponsored bodies as well. So just because they have interest in our entity doesn't mean we are related there. We are related. So all these are few aspects which are supposed to be looked into. So as I was mentioning earlier, who is related party, someone during the year. Please see, it's very important. At any time during the year, at any time during the year, one party has the ability to control. Oh, sorry. One party has the ability to control the other party or exercise significant influence over the other party in making financial or operating decisions. Please note, what is important for us is at any time during the year. It means, say for example, someone has got appointed as CEO and within 3 months he exited also. Should I show them as part of a related party or not? Yes, we should. Yes, we should. Okay. So such aspects are something which we are talking about. Or someone who has got the ability to control the other party or influence the other party. So there is a share transfer which has happened, and one particular existing shareholder who holds 30% has transferred his stake to another person, and now this person is no more a shareholder. So because he holds 30% stake, which is more than 20%, which is he holds significant influence at any point of time during the year. At some point of the time he holds that significant influence, in which case I am supposed to show them as related parties. Okay. And then control means, as I was mentioning, you either need to hold more than 50% of ownership, okay, and I otherwise control the composition of board of directors, or a substantial interest in voting power and the power to direct by statute or agreement the financial or operating policies of the enterprise. In either of these cases, you call that to be control. Okay. And significant influence, I have already discussed about it. So the following amounts to significant influence, we can just quickly go through that. Participation in only financial policy decisions of an enterprise, participation in only operating policy decisions of an enterprise, participation in financial and operating both. That means you could be someone who is only interested in the operations, not keen on financial aspects of the company, or you could be someone who is keen only in the financial aspects of the company but not part of operations, or you could be both. And generally, how do we disclose that, display that significant influence, is by holding 20% or more of the voting power of the enterprise. Now, what's the real need for related party disclosures? The first and foremost aspect is, number one, government would like to know who all are the related parties for this entity, so that it would be easy for them to track things. We need to be very clear with that. Second, from the users of financial statements perspective, we would be interested to understand who is the related party to the entity and what is the amount of transaction which has happened with them. So for that sake also, we would be really interested to understand who is the related party. And the same way, to reflect that, transaction may not be at arm's length price. Now, why does this question arise? Because generally, if it is related party transaction, generally there is a presumption, or I would say misconception, which goes like this: if I sell goods to somebody who is known to me, I would sell it at a discount. Of course, yes. Of course, yes. It might not take place at arm's length price. So it's common in most of the times to give it at a discounted price to someone known to me, rather than someone who is completely unknown. Okay. So when a transaction happens like that between two related parties, the transaction need not always be at arm's length price. It could be a little lesser, definitely most of the range it would be little lesser rather than being at a price which is greater than arm's length price. Okay. So effect on financial position and operating results. So what does this mean? We are trying to identify related party disclosures because we would like to convey to the users of financial statements what is the impact because of this related party transactions on my operations, that is my operating results, that is profit or loss. How much did it impact? Number one. Second, from the balance sheet perspective, financial position perspective, how much is it impacting is something we would like to disclose in the financial statements, so that we would we would convey the same in the notes to accounts. Okay. So the operating results and financial position of an enterprise may be affected by a related party relationship, even if related party transactions do not occur. The mere existence of relationship may be sufficient to affect the transactions of the reporting enterprise with other parties. So so what we need to disclose is not just the relationship with whatever parties we have. We also need to disclose what is the amount of financial impact, be it on operation side and also the financial position side. Okay. And then recording of all possible transactions. Related party transactions need to be disclosed, as sometimes transactions would not have taken place if the related party relationship had not existed. Now, this is a very important aspect. Now, there comes a question. People would come and say, look, we have relationship with 100 parties. Should I disclose about all the 100 relationships? Not really required. If you could disclose what all have got an impact in your financial statements, that would be sufficient. That would be sufficient. Apart from the 5 initial aspects which you have discussed, if there is any relationship which exists, if we can disclose only those relationships in which there is a financial operating results impact and a financial position impact, that is sufficient also. Okay. Okay. Next. So what all related party transactions do we need to give out as disclosures? So there could be purchase or sale of goods, or else there could be purchase or sale of fixed assets, rendering or receiving of services, agency arrangements, or else leasing agreements, transfer of research and development, and then licensing agreements, if at all, if there is any, or financing financing arrangements made, including loans and equity contributions in cash or in kind. Okay. Guarantees and collaterals, management contracts, including for deputation of employment. So if you have any management contracts, that is, I want XYZ employees to be onboarded, and that is being given to a specific related party, in such case that is also supposed to be given as a disclosure. Okay. So various examples are displayed here. So what all should I disclose is something equally important. The reporting enterprise should disclose the following: name of the transacting related party, description of relationship between the parties, description of nature of transaction, volume of transactions, either as an amount or as a part thereof. Okay. Any elements of related party transactions which is necessarily for any understanding of the financial statements. Okay, so if it is like from a loans perspective, say a director has given 50% of the loans outstanding, maybe you can disclose that separately here, stating that it's a loan. Outstanding amount from related parties at the balance sheet date is supposed to be given, and at the same time, if there is any amount which is given by the company outside, that is to the related parties as well, is also supposed to be disclosed. Provisions for doubtful debts due from related parties at the balance sheet date is to be given. Amounts written off or written back of bad debt of debts due from or to the related parties. So what is the amount which you have written off, which is supposed to be received from a related party? This needs to be separately disclosed, because the users would be more interested in this, because if I sell something to a related party and if they do not repay back, that's something very suspicious. So such disclosures is something very important to be made. Okay. Cases when disclosure is not required. Intra-group transactions. What does that mean? Say for example, within a group of entities, if one entity renders services to the another, and but for the common controlling entity, there is no other relationship at all. Doesn't mean that we will have to disclose everything in the related party disclosures. Okay. So such intra-group transactions can be avoided. And then enterprise who have statutory requirement of confidentiality. So there are few entities like defense supporting entities and all, which might not be interested to disclose all the information, in which case such details need not be disclosed. Otherwise, related party relationships of state controlled enterprises with other state controlled enterprises. So if at all there are any such related party relationships between two state controlled enterprise and all, those also can be ignored or avoided from disclosures. Okay. So now let's quickly go through a couple of case studies, and then I'll be open to pick up questions from you. A Limited holds 75% of voting power of B Limited, and B Limited owns 50% voting interest in C Limited. Further, A Limited also holds 25% of voting in C Limited. Would A Limited deem to have control over C Limited, and would it only be considered as exercising significant influence? So from AS 18's perspective, if you see, A Limited has got control over C Limited. Why? Because it directly holds 75% in B, and B holds 50% in C, which is like A also has got similar interest in C. If B happens to be a controlling entity for C, A is also said to have controlling interest in C. So both are supposed to be considered as related parties only. Okay. And apart from that, if you see, A also holds another 25% independently in C. So both of them put together, it has got 75% in C. So definitely it has got controlling in C, controlling interest in C. Second case study, X Limited sold to Y Limited goods having a sales value of 25 lakh during the financial year 31st March 2013. Mr. A, the managing director and chief executive of X Limited, owns nearly 100% of the capital of Y Limited. The sales were made to Y Limited at normal selling price of X Limited. Chief accountant of X does not consider that these sales should be treated any different from other sales made by the company despite being made to controlled company, because the sales were made at normal price and that too at arm's length price. Now, should I disclose them is the question here separately? Of course, yes. See, we are not really looking at whether the transaction happened at arm's length price or not. That's not the ideology here. What is important for us to observe is there a transaction between related party or not? First of all, is there a relationship? Yes, there is a relationship, because the guy to whom we are selling is the sole owner of the entity to which I am selling. Okay, the same guy is part of X Limited as well. So in which case there is someone who has got the ability to influence decisions in both the places. And if the transaction happens within them, definitely yes, it is a related party transaction, and we are supposed to disclose it. We are supposed to disclose the relationship, and also disclose what is the value of transaction which has happened, and what is the impact because of it in the financial statements. Okay. Mr. Raj, a relative of key management personnel, received remuneration of 2.5 lakh for his services in the company for the period from 1/4/21 to 30th June 21. On 1/7/21, he left the services. Should the relative be identified as at the closing date, that is 31st March 22, for the purpose of AS 18? Of course, yes. Why? Because we have stated at any point of time. Okay. So since he has been in a position to influence, or he has been he is someone who is related to key managerial personnel, first thing, they have that ability to influence the decisions in the company. Okay. And most important thing is, even though he has been part of the entity for only few months, it does not disqualify him from disclosure. So definitely yes, disclosure is required even for a part of the financial year if someone happens to be a related party. Okay, the same is given in the solution as well. So there's something important. UP state government holds 60% shares in PQR Limited and 55% shares in ABC Limited. PQR Limited has two subsidiaries, namely P Limited and Q Limited. ABC Limited has two subsidiaries, A Limited and B Limited. Mr. KM is one of the key managerial personnel in PQR Limited. Determine the entity to whom exemption from disclosure of related party transaction is to be given. Also examine the transactions and with whom such exemption applies.
Sir, hello.
Yeah. I thought there is some question which has come in, so I was just going through the
chat box.
No. It's only your question. Thank you.
Yeah.
Yeah. So here you have got two entities. One is PQR Limited, second is ABC Limited. Okay. And PQR has two subsidiaries, P Limited and Q Limited. ABC also has got two subsidiaries. Now, from disclosures perspective, in what all companies disclosure is required is something what he is asking. So let's quickly go through that. So if the government has got control or joint control, okay, in such case there is no requirement to disclose such aspect. That's what we have discussed even before. Okay. And any entity that is a related party, because the same government has control, also need not be disclosed. That means from the existing case, if you see, UP government is investing in two entities. Just because UP government is investing in both these entities, These both will not become related. Number one. Second, PQR or ABC, they need not mention about UP's investment in it. Okay. So, and according to the above paras, for entity P's financial statements, exemption in paragraph 25 applies to transactions with the government of Uttar Pradesh and also transactions with entities PQR and ABC and entities Q, A, and B. So basically, all the transactions within these can be exempt. Similar exemptions are available to entities PQR, ABC, Q, A, and B with the transactions with UP state government and other entities controlled directly or indirectly by UP. Okay. Now, these will not apply for Mr. K or the KM. Why? Because he's an individual. He's an individual, and since there are transactions with Mr. K, these need to be disclosed separately in the related party disclosures. Okay. So broadly, this is with the question. Now, I would be happy to pick up any questions from you people. We can discuss and then bid a sign off.
All right. That's one question that popped up. Is my screen visible?
Oh yeah.
Wait for some more if any. You just take second question. So first question is already taken.
Okay. First question I've already answered. Second, related party, is it 20% holding or only when more than 20%? Sir, 20% is also called a significant influence only, sir.
So we'll wait 1 or 2 minutes, sir.
Yeah,
See if there's any. Will not. Also, will you be sharing this PPT with us so that we can circulate among the registered participants?
Yes, I can share that immediately. I'll put it. Is there anything like I can drop it here itself?
Not yes. You can draft a mail to the SICP itself. We'll compile it. We'll share it along with the recording so that the members will be able to see it, and we can later post it in website also with the recordings.
Sure.
Thank you. Sir. Just will wait for 1 or 2 minutes, and then we'll ask Mr. Sundaran sir to join the sessions. Sir, over to you, sir. You can see any questions. You can unmute yourself, sir.
Sorry?
No, I'm just checking the Sundaran sir for a vote of thanks. So if there's any question, we'll drop your mail, sir, and you can revert us over mail. Actually, we'll be sharing the feedback form with the participants post completion of the session. And if there's any question, we'll share it to you over mail.
Definitely. Thank you.
So that's how we have finished with the questions. You can propose vote of thanks or formal vote of thanks.
Yes, sir.
Yes, sir.
Yes, sir. How you have handled, sir? There's been a lot
Good,
of
sir.
questions also.
Not
Huh?
lot at all. Only 2 questions. Thank you.
Eh,
Not a difficult topic, first of all. We'll
Because-
plan something bigger.
Sir?
We'll plan something bigger, sir.
Yes, sir. Yes, sir. Now, I have an experience on this with regard to this foreign exchange,
Yeah.
where as on 31st March, the guarantee given by the foreign customer, for credit guarantee given, and that what is that percentage, and whether you have to account on the foreign currency value. See, we have given some guarantees, and that value has to be accounted as on 31st, I mean March, in case it is 31st March of this current year. Whereas the books have been, I in one of the bank audit where I was a student, I encountered this, and I was enriched by my employer. So I'm just sharing that experience. As on 31st March, the guarantee given was valued at the original date of entry, but the every year it varies, the exchange rate varies, so the guarantee value has to be, we said that it is a contingent liability and it needs to be disclosed on the current value, for which the bank manager had not agreed at that time. So I had to explain him, and then my employer supported my thoughts and he gave me this. So I saw this when you said about foreign exchange currency, I just reminded, I'm reminded of that. So how was the I think the participants would have been enriched with your ideas and supports. And any other questions? Vandirgam.
No, sir. The questions are taken up, and we'll
Shiva,
finish
any other
separating them. No, sir. We have finished with the questions actually. If there's any, we'll share it with the speakers, mail IDs.
You have any other matter to be discussed, sir? You have any
No,
other
sir.
matter?
I'm done.
We'll have
I'm
time.
done. That's fine.
You are done. Yeah.
Mhm.
Thank you, sir. Thank you, participants, for the excellent support you have given to the speaker and to the programs. And we need more questions so that we all can be enriched in this. Yeah, is that right? Speaker,
One
sir.
question. Maybe we'll take this one if time permits. This one question.
Yeah. So 80% foreign holding company gave deposit to an Indian bank, based on which the bank gave bank guarantee to Indian subsidiary. How does this to be declared? So first of all, I need to understand whether this is a AS company or an Ind-AS company, sir. Number one. If it happens to be a AS company, we do not really require to disclose it as part of, only to the extent of liability identified we will consider. Otherwise, there's no requirement. But if it happens to Ind-AS company, the treatment is completely different. Whoever is posting the question.
It says it's AS company, sir.
Okay. So if it is AS company, generally since there is a bank deposit which is given, and bank guarantee is given to Indian subsidiary, from the receiving end, from the subsidiary's point of view, it is not required to be disclosed, but only for the holding company which is actually given guarantee, only they would have some disclosure requirements.
Thank you, sir. So I will close with the vote of thanks.
That's fine, sir. That's fine, sir. Thank you, Ramesh Kumar, sir, for your excellent presentation. And thanks for the participants who have given your support by attending this program. And we will be doing more programs on a lot of subjects. We seek your excellent support from, and you can get the support from the other friends of yours also, so that the number of participants will give the more encouragement to the speakers also. Yeah, is that? Thank you, sir. Thank you so much. Bye, sir. Selva, thanks to the office also.
Thank you.
Selva is in the back of the systems. Thank you, Selva. Thank you, everybody. Thank you. Bye.
Thank you all. Thank you, Salwa. Thank you, sir. Bye-bye.
Thank you, sir. Thank you. Bye. All the best.